Hello, everybody. My name is Allison Schneider, and I'm a senior fellow with GRESB. I'd like to welcome you to the webinar, Trends in Investing in Sustainable Infrastructure in Emerging Markets. So we're here to discuss investment trends in infrastructure in emerging markets through the lens of sustainability. This webinar will speak to key enablers, inhibitors, and workarounds to advancing investment in sustainable infrastructure in emerging markets and developing economies. Investment in core infrastructure, as we know, is imperative to economic growth and sustainable development. To facilitate the energy transition, we need, I believe, 94 trillion US dollars investment by 2040 to promote climate resilience and achieve the sustainable development goals. The business case for investing in many emerging markets is actually highly robust, underpinned by leading macroeconomic indicators such as GDP growth, population growth, the rise of the middle class, urbanization, education. And emerging markets steward 30% of the world's natural capital, 40% of the minerals required for the energy transition, and 50% of the global workforce. Yet, while some LPs and GPs do focus on or include emerging markets in their core strategy, others are quite wary owing to perceptions of heightened geopolitical risk, investment risk, country risk, rule of law, enforceability of contracts, liquidity risk, market risk. The list goes on, reputational risk. And the question is why? And to help answer these questions, I'd like to welcome our distinguished speakers, Naomi Cooney, Barry Lynch, and Sharina Hussain. So we are here today to answer some of these questions. So I'd like to welcome Naomi. Naomi is a senior financial officer at the World Bank based in Washington, D.C. She focuses on the design and issuance of structured bond transactions that mobilize private capital for sustainable development. And she's worked with emerging market country governments and on enhancing financial protection against disasters. And then Barry Lynch here is a partner and head of operations and energy infrastructure at Actis, based in London, the UK. And Actis is a leading investor in growth markets across Asia, Africa, and Latin America, and recently joined forces with General Atlantic, creating a diversified global investment platform with $87 billion US assets under management. And then we have Sharina Hussain, who is an academic, a lawyer, and founder of Academic Collaboration Consulting. In addition to her role as an instructor at the Schulich School of Business at York University, she is an academic advisor to the Global Infrastructure Hub and was the first academic director of the G7 Investor Leadership Network Program for Emerging Market Fellows. And that was how I first met Sharina a few years ago. So let's start off talking a little bit about each of you, and then we will get into a few questions. So Barry, can you tell us a little bit about your role?
Yeah, thanks, Alison. Hi, everyone. So as per the intro, I partner with the firm Actis, and we invest predominantly in the energy transition and digital data space across the growth markets, Latin America, Eastern Europe, Middle East, Africa, India, broader Asia. So what that means is we invest in large-scale renewable generation, large-scale battery storage, gas-fired power generation, but also transmission lines and data centers, and also some telco towers and things like that. So anything to do with the energy transition or the digital world. And we invest in the growth markets. That's our strategy. We've been doing so for as a private firm for over 20 years, but our pedigree comes from back from the mid-1940s when Actis, or what was then the Commonwealth Development Corporation, was set up by the British government. But we spun out as a private entity 20 years ago. And as mentioned, we're now the infrastructure division of General Atlantic, which is a large growth equity investor. So our strategy hasn't changed. It's the fundamentals of what we do is large-scale infrastructure in the parts of the world where we believe the population needs it most.
What I find fascinating, Barry, is Actis has been investing in emerging markets for so many years that this is not something to shy away from. This is your area of expertise.
Yeah, okay. So some people call it the rest of the world. We call it the most of the world.
The most of the world. I like that. Naomi, tell us a little bit about your role.
Yeah, thanks, Alison, and hi, everyone. So for those that aren't familiar, maybe the World Bank is a development organization that's owned by 189 member countries. The World Bank is the sort of biggest provider of development finance in developing countries for about, it's been lending and providing grants to developing countries for about 75 years. So the bank provides lending, grants, technical assistance to projects across infrastructure, education, health, across various different themes and sectors. And we do so by borrowing money in the capital markets. So the World Bank issues about 60 billion of bonds a year, or will do this year, to support all of that development in developing countries. I work in the World Bank Treasury, not in our core funding team, but in a team that sits very much alongside that, where our goal or our purpose is really to come up with new, innovative ways to bring institutional investors who might otherwise not be interested in investing directly in emerging markets, in finding ways to bring them in to mobilize additional private capital that go beyond World Bank lending to support projects in emerging markets.
Okay, thanks, Naomi. And Sharina, go ahead. Tell us a little about your role.
Well, thank you so much for having me, and good morning, good afternoon, everyone. In my role, I look at predominantly how then to bridge a lot of the different capital sources as well as the infrastructure programs, as well as policy frameworks amongst multiple governments around the world, including those in emerging markets. So, in my capacity as an academic, as well as working alongside different organizations with the objective of trying to encourage investment into emerging markets, what we do is we examine some of the investment behavior and decision making capabilities of different investors, particularly those with institutional capacities, but also working alongside governments all across the globe in order to address things such as what do their enabling frameworks look like, but also elements related to capacity building, how to better prepare decision makers to be able to understand some of the concerns and opportunities that institutional investors and other investors are ultimately looking for when they're contemplating infrastructure investments within emerging markets. And I've been very fortunate in being able to work across different continents, different governments, as well as different tiers of investors in order to then apply the leading research in a way to then unlock different types of sustainable infrastructure investments across different corners of the globe.
Thank you, Sharina. Great. Okay, so we have a wonderful panel here that's curated to answer these questions. So the first question to pose is, how can we actually mobilize capital at scale and speed in infrastructure investments in emerging markets, considering the climate change crisis, etc.? For example, we know the World Bank strives to de-risk projects using concessional finance, blended finance, and related strategies to attract private capital. Emerging market debt is expected to generate higher global returns than global equities over the next decade. So, can you give examples of investment instruments, structures, or strategies that are actually working? So, maybe we'll start off with Naomi. The World Bank has recently issued outcome bonds, I understand. Perhaps you could talk a little bit about this?
Yeah, very happy to, Alison. I mean, I mentioned 60 billion of bond issuance, and that supports our overall sustainable development lending program. And the bank is being asked to do more. And part of that is the work that my team is doing in trying to come up with innovative structures to mobilize additional capital for projects maybe that don't have access to World Bank lending or need additional lending. So these sort of structured outcome bonds that we come up with are mobilizing additional capital. The outcome bond really is an innovative new structure where, if I sort of describe what an outcome bond is,
give an example.
It's a principal protected bond. So we issue a World Bank bond where the principal supports all of our sustainable development activities like any other World Bank bond. But the unique feature with them is that instead of paying investors a regular World Bank coupon, we take a portion of that coupon and instead we pass that to a project to finance a project. So what that looks like is investors would receive a smaller than ordinary guaranteed World Bank coupon. So say, for hypothetical sake, if a regular World Bank coupon is about 4%, maybe we pay them 2% as a guaranteed coupon. and the other 2% over the term of the bond. We take the net present value of it. We do an interest rate swap with an investment bank to come up with the net present value of what those foregone coupons would be, and we pass those to a project. Now, these aren't philanthropic investors. They're goal return-seeking investors.
Okay.
So they want a return for that coupon that they're giving
Sure.
up. And that return that they get is dependent on the outcomes of the project. Where if the project achieves certain KPIs, achieves certain outcomes, then they get a variable coupon on top of their guaranteed coupon that is linked to the outcomes of the project.
And are these sustainability type outcomes, Naomi?
They are. Maybe let me give two sort of concrete recent examples. So in August of last year, we issued what we called the Amazon Reforestation Linked Bond. It was a $225 million bond. That $225 million supports the bank's overall sustainable development activities. We paid a 1.75% guaranteed minimum coupon to investors. Those foregone coupons that I talked about, that amounts to about 36 million that's passed to the project. That project those funds are used by a project developer to plant trees in the Amazon, in an area that of degraded land in the Amazon. And they actually had the project developer had an agreement with Microsoft, where Microsoft was committing to buy the carbon credits in the future from the project. So basically, the investors, a portion of that revenue from the Microsoft carbon offtake agreement, instead of going to the project developer, flows to the World Bank to provide that variable coupon to investors. So there, it's based on sort of the carbon emissions or reductions from the project, the carbon credits that are generated. But there are also a whole host of other development and social outcomes that are sort of tracked and monitored by the project. Other projects have been, we did a water purification project in Vietnam, where the project was around the manufacturing and distributing of water purifiers to schools in rural Vietnam. Another was on a plastic waste recycling plants in Ghana and Indonesia. So projects very much that are aligned with the goals of the World Bank, but where we
and the sustainable
found a
development
way to put sort of private capital directly into those projects, and where investors are taking risk directly in projects where they don't have that sort of direct exposure in a general World Bank bond.
Very fascinating and highly innovative. Thank you, Naomi. Barry, how important is it for Actis to be able to partner with entities like the IFC or with Actis being the major equity provider?
Yeah, we work very closely with IFC and also the MEGA division in the World Bank. So there's a couple of aspects. If we're doing a particularly large project in a relative, and it's the first of its kind, say in a new market, maybe a very large wind farm in Senegal, or building a large solar project with batteries in Bulgaria. And take the Bulgarian example, we would work with IFC to come in as one of the lenders on the project finance side. So we would, in a typical example, we would provide, say, 30% of the capital cost as equity, and then approximately 70% would be senior debt, long-term senior debt. So bringing IFC in early into that process to take a portion of that debt gives other multilateral lenders or other commercial lenders in that market the comfort that it's been put through the rigorous assessment of IFC World Bank in terms of due diligence as a lender, and that their ability to provide debt then just gives that comfort factor to other lenders who may not have been in a position to lend to that project without their involvement. And we do that time and time again, particularly where it's one of the first movers in a new market. So a very large renewable project in a market, maybe on something at scale. And I think that's very beneficial. They provide that catalyst for others to follow. And then as that market evolves and more projects and more private capital comes in, then the need for that reduces, and then IFC World Bank will focus on, or we talk to them about other projects in other markets to again provide that catalyst. And I think that's a really nice example of the value it brings. And
collaboration. Yeah.
In terms of equities, the equity insurance products where there might be a particular government contract in the mix, and again that's hugely beneficial to us and to our equity investors to give them comfort as well. But yeah, it's a close partnership in terms of setting the tone and a high level of rigor in the DD process for commercial lenders.
Right. Very, very interesting. Yeah, it's a lot to chew at one time, but if everybody's taking a little piece of it, so there you go. Well, let's, Sharina, anything to add here from your perspective, from the perspective of an academic and an advisor to governments?
Yes, and just to add, in terms of understanding how then to really position the emerging market investment framework and what are some of the different pillars that we talk about in that regard, we had done a considerable amount of research alongside about a dozen institutional investors that are actively investing in different types of products in emerging markets to understand what are some of the decision-making processes that are in place to then encourage moving from smaller investments or co-investments into having larger check size, including investing into equity into some emerging markets across different continents. And through that research, we're able to devise a three-pronged investment framework that otherwise classifies a lot of the different variables that are considered when contemplating investing in emerging markets. One of the categories is known as the macro factors. And those are many of the points that you brought up earlier, Allison,
Mhm.
when you were identifying elements that would suggest that you should consider investing in emerging markets or even some of the risks that come into play, such as looking at things related to the growth potential, the size of the economic activity and the GDP growth, what are some of the demographics, and the opportunity to access capital, balancing that alongside things such as macro stability in the business environment, balancing items such as what are the political centrality, sovereign credit rating, as well as elements related to corruption and rule of law. But that's really just one category that's taken into consideration. The next one is really looking at the opportunity set. And that's where there's a lot of interest that comes with what could be then achieved by virtue of the fact that there could be scalability of different sectors, particularly those in the decarbonization space, the energy transition. What are some of the track records we're seeing amongst different private investments? And also some of the classic investment attributes that you would consider, whether it's an emerging market investment or somewhere else, such as what's the risk adjusted returns, what's the regulatory framework, what's the stability of the revenue structure, and that being the second pillar. But there's also a third pillar that comes into the investment framework that we identified, and I think it's something to really chew on when you're contemplating investments into emerging markets, and that is known as implementation capability. That's looking at the investor at the origination, but also deal execution, the asset management, as well as the partnerships that exist within local markets, boots on the ground, as well as other organizations, such as some that we've talked about so far, that can help de risk and manage some of the considerations that come with making investment and maintaining those investments within emerging markets. So, that as a framework has proved quite well in order to position how different investment behaviors, how different types of markets become more or less attractive and more mature when it comes to then being an area that different investors contemplate making additional capital investments into.
Very comprehensive, Sharina. Thank you. Uh, a lot to unpack there. Okay, well, on the theme of de-risking, how do you de-risk investments in emerging markets? Can we decipher and demystify the myths of investing in emerging markets by having a more robust approach to risk mitigation? Barry, the Actus Atlas I saw on your website describes the world in 6 buckets, from global influencers to big middle supply chain heroes, stable but small, natural resource winners, and structurally challenged. Actus tracks these and other key metrics into an investment taxonomy for emerging markets I saw. Can you speak to this? And is this one way that you
Yeah,
approach risk? Yeah, that you, yeah. How
yeah,
do
it's one
you,
way. It's one
yeah.
way. So, like in terms of, we're not a philanthropic organization either. So, our investors, which are large public pension funds, sovereign wealth funds, etc., they they require us to deliver a reasonable return, an appropriate return with their capital in our investments. So, in simple terms, demystifying is a good way to put it. Um, one graph we like to show our investors is default rates on long-term project finance loans in the infrastructure space. And in the emerging markets or the growth markets, historically over the last 20 years, default rates are lower on large
Wow.
scale in growth
I
markets.
wish you had a megaphone that you could just basically
Yeah,
say
I
that
think
to the
we just
world,
got
right?
I think the way we describe it is that there are perceived stormier waters in our markets. So therefore the ships we design and build to navigate those waters are arguably more robust than they are in the developed markets. So in terms of, say, the financing structures we put in place, the buffers around that, the contingency we build into construction costs and things like that are probably a little more robust in our markets, and therefore that gives us that strength to navigate any difficult scenarios. But ultimately, we don't lower our standards. If you take operational performance, safety performance, ESG performance, you visit a project that we own in Nigeria or India or Brazil, the standards should be exactly the same than if that project was in Germany or Texas or the UK or Japan. So I think that's where we start. In terms of how we look at the world, there's the global influencers. So that's, USA, China, Japan. We invest quite heavily in Japan. But then the key ones for us are, say, those big middles, the countries that are G20 members with the substantial financial resources. So target markets for us there would be Brazil, India, Mexico, South Korea, all of which we invest across our spectrum in those markets for the long term. The supply chain heroes would be those that are materially exposed globally, but not in the resource way. So that's the likes of Malaysia, Philippines, Thailand, Vietnam.
Right.
Where we're looking at what is the power requirement, what is the digital requirement for those. Then your stable but smalls would be the likes of Bulgaria, Lithuania, Morocco, Romania, Uruguay, which all are investable in a way, because we also need scale in a market. We want to go in to deploy hundreds of millions of dollars of capital. The natural resources winners are quite obvious, like your Chile, Colombia, GCC members, Peru, South Africa, etc., all of which we invest in, where we kind of see what is the economic synergies we can find with that economy in terms of what they require from us. Then there's the structurally challenged, which again, we invest in many of these too, your likes of Egypt, Ghana, Kenya, Nigeria, Turkey, where there are structural issues either in the economy, etc. But we see what are the opportunities, and it's if we're building large-scale power assets, what is the long-term contracted strategy we could have to store electricity for 10, 15, 20 years, maybe either to a utility or to a large corporate, and therefore we can use that to finance the project and then make it a stable investment over the long term. So we're demystifying.
In the structurally challenged markets, there's still opportunities.
We're building and owning assets in all those markets. But again, it comes from us being on the ground for decades. It's that implementation skills Sharina spoke about. We're on the ground, we're in those markets delivering, billions of dollars of investment across those. And, it's our backyard. And we have that experience. So we do see some come in and try and do it for the first time. And it's like any market, you've got to learn your lessons over the years. And we've done that, and it's quite successful for us.
Right. Great. Okay. Thank you, Barry. Naomi, can you talk about the investor base and how you attract capital to these investments? What kind of mechanisms are in place to mitigate risks for investors, and what type of reporting investors can expect during the investment period?
Yeah, I mean, and to echo, some of what Barry said. If only every investor was like Barry, where they have decades of experience. The reality is that some of the investors that we're working with don't. And we found this new outcome bond model as a really nice way for investors to kind of dip their toes into emerging markets, where they're not putting any capital at risk. They're buying a AAA principal protected. So we actually get them rated, these outcome bonds, AAA small p, the rating that a lot of people aren't even aware of, where actually the principal is protected. So all they're putting at risk is a portion of their coupon, a portion of the guaranteed coupon they're giving up, putting that into a project. And it's that piece that they're taking risk on. So it's a nice way for them to dip their toes into taking direct exposure in emerging markets, and hopefully over time they'll take more. But other things that Barry mentioned, having buffers in place in terms of the flow of revenue that we securitize from a project to support the variable coupon. We make sure we have sufficient buffers in that. Lots of considerations in the structuring. Every transaction is different. Every project is different. So coming up with structures to reduce the risk for investors, and exactly not lowering the standards for these projects, right? These are return-seeking investors who really care about risks and want to hold them to certain standards. The type of investors, these really are fixed income institutional investors. What we've seen to date in our outcome bonds, our first outcome bond was issued about 3 or 4 years ago, and we had 4 or 5 investors, and it's kind of grown since then. Really we did a bond. It was called the emission reduction linked bond. That was the water purification one in Vietnam. In was it 2022 we issued that bond. But it really, from that, we were able to use that to do a lot of education with other investors and bring other investors into the space. It's investors in the US and Canada, in Europe, some of the Nordic countries in Europe, not so much France or Germany or yet. But they are across sort of asset managers like Nuveen and Mackenzie, and I can name some of these because they often are named in our press releases. Some pension funds.
So yeah.
Yeah. And they are, as I said, return-seeking investors, and they also like this outcome bond model because it actually not only are they sort of directly supporting projects in developing countries that have, you know, good sustainable development stories, but they also potentially provide a yield pickup compared to a regular World Bank bond. So we're asking them to take some risk in a project, and if the project is successful, they're rewarded for that. So they get it might be a 50 basis point or 100 basis point pickup compared to what they would earn on a regular World Bank bond. Right. So they're investors who care about sustainable development, but who also care about yield and are interested in, you know, being able to earn any additional yield over an ordinary sort of World Bank bond.
Right. Very, very clever, actually. It almost incentivizes them to keep investing in emerging markets and in outcome bonds. And as you said, getting your big toe in the water and then going from there to something, a larger investment. Okay, Sharina, are investors overly reliant on outdated country risk assessments? Or are governments not doing enough to market themselves or update their taxonomies to get the information out there that they're open for investment? Is governance more of an issue in emerging market investments too? Is this another issue? What is going on here? Can you give us your perspective?
Well, there's still a long way for us to go in order to demystify in many cases, the arbitrary risk premium that's put upon any emerging market. And what that can otherwise do is stop the assessment of any potential opportunity, or it can make it very challenging in order to justify that and move those project and investments forward. And when we stop and think about why do we still have, in many cases, just a blanket risk premium adjusted to any, say, investment opportunity that might be, say, in continental Africa or might be in certain countries within South America, it really boils down to the information transparency as it relates to what are in fact those risks. Are those risks being well priced? And is there ways in which there could be the communication to better be able to understand whether or not that premium is appropriate? Or maybe it is something that can be adjusted, knowing that there are advancements in different areas, whether it's macro forces, opportunity sets, or through the availability of different mechanisms that we talked about so far as it relates to risk management. And that exercise is one in which it goes two ways. It's not necessarily from the perspective that only investors need to do the digging to understand better what is the landscape within different countries that they're contemplating investments, but also on behalf of different governments in different regions whereby the ability to introduce that information, but also in a way that's digestible to different investors and investor managers, is something that is an ongoing process. I've been fortunate to work on several initiatives, in which case being able to not only adopt taxonomies that address different risk profiles that are somewhat common, but again, not well understood from the perspective of identifying and promoting different investment opportunities within government ministries, but also from the perspective of being able to tie that to different mandates, such as those related to the energy transition or broader sustainability objectives.
Sure.
That is a longer term governance initiative, but fortunately, there have been a variety of different organizations and more active governments within emerging markets that are accepting that there needs to be better flow of information, or else they're going to be constantly stuck with outdated risk premiums that could otherwise turn away different sources of private capital and mean some of those much needed infrastructure projects are not getting the attention amongst the different investors out there. So I would say is to your bigger question, is this a governance issue? In some ways it is, but it also is something more along the lines of education and capacity building as it relates
Mhm.
to be able to understand common dialogue related to what are the investors looking for and how can that be translated in terms of what does that infrastructure pipeline look like, or even priorities, and then leaving open the opportunity for different investors to contemplate what could those investments look like and enable that communication.
Great. Thank you, Sharina. Okay, pivoting a little bit, let's talk about sustainability considerations here and how they factor in emerging market investments versus developed market investments. And just note that the GRESB assessment in 2024, we saw that 8% of infrastructure assessments were emerging market entities. And the mean score for those infra assessments was 83% versus 86% for all infrastructure assessment scores. So in other words, the emerging market entities that are doing the GRESB assessment are doing quite well. The overall score is just slightly behind, not really meaningfully behind the mean scores. So Barry, Actis seems focused on investments in energy transition. This is your area. And looking at your website, we see you have invested in Dhaka's largest wind farm, and you have projects in the Philippines, India, etc. Do you use GRESB data to monitor progress, or how do you use GRESB data to monitor sustainability progress or progress towards climate resilience, adaptation, or any of the other things you're looking at, avoided emissions, etc.? How does the GRESB data factor in there for you?
Yeah, thank you. And it's good to see that gap closing. I think that will close even more as a function of more volume of assets using the same system over time. Yeah, we do. There's two aspects. One is the due diligence process, where we would look at an investment and think, right, what is its climate resiliency? We're investing in infrastructure projects, which can 20, 30, 40-year life. So we're looking at what might be the flood risk or storm risk on that, what affect that. We work closely with our insurance underwriters to think long-term about that. An example, recently we have a large gas-fired power plant in Bangladesh, and during the DD process we worked closely with IFC and the World Bank Group on that, and we analysed it together, and we felt that as designed it didn't have sufficient flood protection risk for the event of that 50-year storm and flood. So we worked closely with IFC and World Bank as part of the financing package to agree a redesigned and better flood resilience system for the asset, and that's what we implemented as part of, it's essentially a CP to the financing that we would contractually start putting that in place. I think that's an example of us working with World Bank Group as on the lender side and also the equity side to ensure that that asset was built to a higher standard than maybe others might have felt it needed to be. And the same, we're looking at weather risk, particularly large-scale solar projects. If there is extreme weather, you can have an impact on that, because we're also want to ensure that our insurance premium over time, does not suffer, because that could be a meaningful cost. So I think it is more and more important, both through the DD phase, and then we try and track through the investment cycle. We want to be able to show, if we're coming at the exit of an asset, to show how we've improved that asset from all aspects of ESG, whether that's emissions reduction and job creation and every other aspect of governance. So it's quite important for us through DD and to demonstrate to our investors through the ownership period that we have made improvements. So yeah, it's more important than you might think. And again, that's ensuring the financial safety of the asset as well. Kind of thinking about, your IRR is all well and good if you haven't managed flood risk or weather risk.
Exactly. The financial materiality of sustainability indicators is much greater than what we might think at first blush. Okay, very interesting. So you're using the sustainability data all the way through the investment process, from due diligence all the way through valuations and exits. Great. Okay. Naomi, what sectors or types of projects in emerging markets have the best potential for outcome bond funding, and what are the key ingredients for success? And is this type of financing scalable to meet the growing needs for investments in emerging markets? This is my question. You feel free to answer it slightly differently, since we've talked quite a bit about outcome bonds already.
Yeah, and maybe to change track a little bit, actually, to go back to something that Barry said about reducing some of the risk in these, like, particularly big infrastructure projects. I mean, I also work in, and just wanted to highlight catastrophe bonds, which people may not be
Very
familiar with,
interesting.
which are
Yeah.
a mechanism to pass catastrophe risk to capital markets investors. I mean, typically catastrophe bonds are used by insurance and reinsurance companies in the US that have big exposure to earthquake and hurricane risk, and you'll all have seen all these wildfires in LA over the last couple of weeks, where there'll be some cat bonds that have exposure to those. But we have seen, they haven't been used yet, but we've certainly seen discussions and interest around some World Bank projects and other projects potentially using catastrophe bonds as a means to transfer some of that risk to capital markets investors. So it's an interesting angle outside of the insurance market. It complements the insurance market and provides an additional layer of coverage, particularly if it's a big project where you need coverage of 2, 3, 400 million. Sometimes the cat bond market provides a good avenue for projects.
I imagine the demand for catastrophe bonds is probably going to go up post the California wildfires.
Although it may be, I mean, there's always time periods of, the cat bond market sees big losses and suddenly pricing shifts. And so it's always a bit of supply and demand. But yeah, the market has been growing over the last 10, 15 years. It's about a $40 billion market now, the cat bond market, and continues to grow as the needs for insurance continue to grow. It's and the interesting thing actually for the emerging markets is that most of the cat bond market is exposed to US hurricane and earthquake risk. It's 70-80% US earthquake and hurricane. So when we bring catastrophe bonds, generally we're bringing them for financial protection for governments, and governments like Mexico, Chile, Jamaica, the Philippines. And all of those risks are diversifying for the cat bond investors. So they tend to price a bit better than maybe your risks in the US, because they provide a diversifier for the investors. And so it could be interesting for a project in an emerging market.
Definitely.
But back to your other question around outcome bonds and are they scalable? And I mean, we have a growing pipeline. We've issued 5 outcome bonds. It has been slow, but we have a huge pipeline that we're very excited about. We also have heard of other issuers who have been looking at this outcome bond model, and we think it is a really good potential, particularly for projects that have future revenue streams that maybe don't have access to capital markets, don't necessarily have all of the equity investments they want, but they want some other source of financing, and they have a revenue stream that we can securitize in a bond transaction. That revenue stream, it could be carbon credits like our Amazon Reforestation Linked Bond. We've done the plastic bond where it's plastic credits. We actually have some projects where there's a donor who wants to support a project, but only on a pay for success basis. So how do we can we take that donor future grant and wrap that as the sort of outcome payment? Or other projects where maybe there's a revenue stream from some commodity. Even we've looked at funds where the return on the funds provide the outcome payment to investors. So lots of different as long as there's a revenue stream that you can securitize in order to mobilize upfront financing for a project.
You can be very innovative. Yeah, very interesting. Okay, great. So Sharina, let's see, what question did I have? Yes, what sustainability standards, frameworks, labels, etc., do you promote to governments when you advise them, or do you rely upon? For example, there's GRESB, of course, there's SURE, there's Blue Dot, Envision, Equator, Fast Infra, or standards, Partnership for Carbon Accounting Financials, SASB, etc. So can you speak to that?
Well, the short answer is all of them, depending upon the situation as well as the sophistication of those different governments, depending upon how far they are when it comes to crafting sustainability and embedding that within their infrastructure investment mandates, as well as what that means across our different ministries that otherwise touch upon areas promoting and encouraging private capital to then invest in their infrastructure. I'll give you an example of a situation whereby a variety of different senior government officials from many emerging markets were really just contemplating what exactly does ESG mean for purposes of them being able to position their infrastructure development pipeline as a way that then aligns with that. So what it meant is they had a very important role to play when it comes to then identifying some of the indicators and having that match some of
Hmm.
the standards that exist to then facilitate amongst different potential investors or those conducting due diligence some of the early prep work to see whether or not there's a alignment with that investment program that these governments are putting forward. And to support that, we did work upon, say, the GRESB framework, as well as a few others, such as Fast Infra, as a way to then introduce not only language, but some of the standards, the KPIs, how to then connect many
Hmm.
different objectives that on one end seem very qualitative and very difficult to dissect downwards to something that's measurable and align it with something that are more mainstream and then well known to the investor
Hmm.
universe. So in that regard, I would say that pool of potential sources is always evolving. We tend to see taxonomies evolve every year or whenever there's a major
Right,
conference.
right.
But when you really boil it down, there are some key principles that haven't quite changed all that much, whether it's PRI, whatever it is, the UN SDGs. Some of those factors remain the same, and there are a variety of different organizations that have standards that do draw upon and take us back to that, such as GRESB. So that's where I would see there's still a lot of work to be done to create that standardization, but it does have a critical role to play. And in a lot of the work we're seeing with governments, they are taking upon those and they're incorporating in order to facilitate that dialogue amongst different investors.
Okay, thank you, Sharina. There's a lot of frameworks out there. We're also starting to see a trend of convergence in terms of reporting and the International Sustainability Standards Board, etc. The S1 and S2 standards are going to be helpful in that way as well. Okay, just to the audience, we're going to be wrapping up soon. And since there's any questions, if you have any questions, you can go ahead and post them in the chat. If there's not any questions, we can continue talking. We do have a couple more questions here. But if the audience has any questions that you'd like us to answer, feel free to put it in the chat. So we talked a little bit about the impacts of severe weather and climate change on investments in emerging markets. And of course, weather is going to impact all markets, but particularly in emerging markets, they may be less prepared to deal with those impacts. And especially for countries like India, for example, which is experiencing very hot weather nearly every day in 2023 and 2024, this could have a major impact on quality of life, let alone let alone infrastructure. Are investors sufficiently factoring in the impacts of severe weather and climate change on investments in emerging markets? I would like to take that. Maybe we'll just have one person, or we'll just do a very quick rapid round here since we're coming up on the 15 minutes to the end.
Yeah, for me, I think yes. I think if you're the right investors with the right lending group, whether that's IFC or the commercial banks and the insurance companies that are involved, the robust project finance structures require all these questions to be asked.
Yeah.
Ironically, I'm trying to think of what weather incident affected us in the last 5 years, and it probably was the Texas freeze. We had a lot of gas assets in Mexico, sourcing a lot of gas in the US from Texas.
Right.
I'm trying to think of weather events that have impacted some of our investments, and that is probably the one that comes to mind. I think what we are seeing is changing weather patterns. So,
Yes.
different rainfall patterns, which affect different wind patterns. And we would model the wind for a wind asset, what's it going to perform like over the next 20 years. And we are seeing changes in that driven by weather. Some on the positive, some on the negative. For Brazil, for example, has seen very different rainfall patterns in the last 5 years. That has affected the wind patterns. So things like that are changing. And it's that certainty is what we look for in investment. So it's trying to model that has become more complex. Cloud cover as well. We've seen kind of changing profiles of that, which obviously affects solar assets. But in terms of disaster type situations, we have been able to avoid those either, I would hope, by choice as opposed to by luck. But could be a little bit of both. But I think, yeah, it's just that you're right. India has seen extreme weather, but there are certain areas in India where we look at that flood risk and what is that weather risk.
Right.
And we invest in certain states or certain parts of certain countries, and for the reasons you described.
Okay, great. Anyone else want to chime in on that?
I mean, yeah, our experience, Alison, it has to be a core part of any due diligence for a project. I mean, even our Amazon Reforestation Linked Bond, we had, you know, calls, but we arranged for the investors to speak directly with the teams in Brazil, and one of their key questions, right, the key risk there is that there's a fire that burns down the forest. So how are they protecting against that? What kind of mechanisms do they have in place to prevent the spread of fire? So yeah, it absolutely has to be addressed by investors.
Exactly. Okay. All right. Shrina, anything you want to add?
Just to add, that element of recognition is very much from what we're seeing is, standard. There's this appreciation that there are climate risks, and be able to recognize those risks is something that has become more and more commonplace. The opportunity to then know how best to price that risk and look at risk mitigation opportunities, that's where there's still a lot of variation we find amongst some of the investors in certain emerging markets. And that does speak to not only the financial instruments at play, but also the robustness of the different frameworks that exist to manage those risks. Some cases, the idea of the 50-year event or the 100-year event does need repricing because it appears more frequently, so much so that there is a need to adjust how you price that and when, who takes those risks in that regard. But we're moving in that direction, and every region is different, and some of those climate risks do manifest in different ways. As Barry mentioned, the Texas freeze, is that something that was once a 100-year event, or is that something that's becoming a little more frequent? So you have to reprice that risk, and what does that mean across the board, or even in the situation of just the magnitude of prevalent high temperatures, and what does that do to the road infrastructure, and does that result in accelerated degradation? And how then do we address that as well? So that's where we're seeing a lot more, I would say, I would say creativity, but a lot more thought is going into how now to address those climate risks, how to bear those risks, and then contemplate that in a lot of the forthcoming evaluations of different investments.
Okay, great. Thank you, Shrina. Well, let's go back to the overarching topic of the webinar, which was what trends are we seeing in investments in infrastructure in emerging markets? Are certain markets becoming more or less investable? Brazil, India, South Korea, etc. What is being invested in? Are we seeing more investments in data centers in emerging markets and more transportation, bridges, etc.? So just overall, what trends are you actually seeing in the last few years?
I think for us, it's the duality of energy transition and digital is very exciting. So, when we're talking to hyperscalers, whether that's in India or Philippines or Japan, they want the energy source from us, but we also do data centers. So it's about talking about how do we essentially create digital campuses which have firm power through wind and solar and batteries at a large scale. And I think that digital component, some would argue that the energy business is now a play on the digital business. And that is a significant industrial change. And I think we don't disagree with that. I think there's no conversation about electricity today that isn't intertwined with digital and AI. I think that's a theme we're seeing everywhere. And it's very exciting because we invest on both sides. And to be able to deliver an energy solution alongside the digital assets and the data centers is a huge theme for us. And I think it's going to be that way for the next 5 to 10 years easily, which is very exciting.
Makes a lot of sense. I mean, data centers gobble up a lot of energy, so you have to solve that problem. And then from a carbon emissions perspective, that will be another part. But you're also very involved in alternative energy, so you kind of got a few solutions there all together. So very unique. Okay, great. Naomi or Shrina, Naomi, any trends that you're seeing in investments in emerging markets that you'd like to speak to?
Generally, more and more investor interest. Particularly, I mean, the projects that I'm looking at are more in the carbon emission reduction and avoidance projects, and some of them are like new technologies, like new renewable energy projects, new biochar as a new sort of alternative fertilizer for farmers. So there is growing interest. And then, I mean, you mentioned about what countries or regions. I mean, the World Bank, obviously, we support all of our member countries. Some countries are easier than others. But that doesn't mean that investment in the tougher countries isn't possible. It maybe just means that there's a little bit of higher return requirements where there maybe is a perception of more risk. Yeah.
Great. Okay. And is there more competition for investments in emerging markets in the infrastructure space? I'm thinking like with state-owned enterprises, the whole Belt and Road Initiative. Is that you're seeing anything with that at all?
Yeah,
I think what I was going to say about I think there's continues to be a growing need. So there's certainly competition maybe from the project developers. So plenty of opportunities, I think, for investors.
Yeah, I agree. And I think we like competition. We want to see more people coming into our markets and investing. You know, it normalizes, it shows that the risk premium maybe it just gives confidence to everybody. I think when, no one wants to be the sole investor in a large asset in a country and no one follows them. So I think we like competition. We like to create that industry in the markets where we are. And I think we're seeing that all the time. There's always strategic changes. Big strategics will say, look, we need to refocus back to our home markets. Therefore, we're diversifying out of a particular region. And that's an opportunity for us too, in terms of asset acquisitions. But yeah, it's competition is good. We're seeing a lot of it in our key markets for the right investments. And we hope it remains that way.
Great. Shrina, any trends that you're seeing?
I can speak to it from the perspective of different emerging market governments and what they're preparing and promoting as being those areas that they want to see greater investment in. And as we identified already, energy. That is a sector in which across the board, whether it's continental Africa, whether it is in areas of South America or Southeast Asia, energy consistently is an industry where there's quite a lot of interest in order to encourage more investments. Interestingly enough, the idea of you call it economic infrastructure, so those related to energy, transport, telecommunications, that hasn't necessarily shifted all that much as, say global trends have emerged, but this idea of social infrastructure, so whether that means elements related to city building, hospitals, schools, there's actually been a bit of a fracturing that we witnessed in terms of, is that going to be something that would be more attractive to local investors or those who are regionally based versus those that are from outside of the emerging market network and looking to make the investment in. So I anticipate that will continue to be the case, especially as Naomi and Barry mentioned, like as a lot of markets become more mature in terms of having more track record with institutional investors or investment landscapes. You get a lot more competition. And with that, there could be different sectors that become more or less attractive to different investors from abroad, as opposed to those that have traditionally remained locally based because of the absence of interest from outside.
Okay, interesting. Okay, we have a couple of questions from the audience here. What is the growth opportunity for sustainable infrastructure in Africa and Latin America? Two different regions. Would like to speak to that.
Yeah, sure. Look, we invest in both heavily, have done for 20 years. We're one of the biggest private investors across energy generation, transmission lines, data centers in those markets. Yeah, it's huge. And I think it's one of the key things people worry about is currency risk. So a lot of our investors, we do look for kind of hard currency exposure, and that is achievable in many of those markets. That is one thing that has to be managed. But I think, yeah, look, the growth is huge. You look at the population, you look at the requirement for electricity and data centers across those markets, and it's huge in terms of population growth, etc. So it's insatiable, I would say. And therefore, we would put 20, 30, 40% of our capital in each fund cycle into those two markets successfully.
Excellent, excellent. When you talked about currency, so are you hedging the currency risk, or how do you deal with that?
Yeah, generally a lot of our debt will be kind of US dollar debt. So we
Right.
put hedging structures in place with the lenders. Where there is local currency revenue, generally in our type of infrastructure projects, they are inflation linked. So there is a natural hedge there where your revenue line is inflation linked, and that then is a hedge in itself, as a hedge against any currency issues.
Great. Okay, just wrapping up with the last question here. How would you respond to emerging backlash on ESG initiatives, identifying it as a mere marketing tactic and not as a substantial driver for financial gain?
Yeah, we've been investing through an ESG ethos for many years, and our returns are quite satisfactory to our investors.
Quite material. Yeah.
The license to operate in our markets, it's also a key part of attracting talent into your investee companies and into your firm. You know, if young talent today expect to see an investor that looks through that lens, otherwise they're not interested in joining. I think that's something as well that needs to be thought about.
Yeah, I mean, to echo what Barry says, if I was to finish on anything, it's that, right? You can have, there can be side by side, right? A good project that, you know, has lots of good outcomes, sustainable, social, economic outcomes, but also have be a good return for investors. I mean, they exist side by side.
Great.
And I would add, if you think of it from the perspective of risk, a lot of those elements are risk management tools and solid risk management, whether it's in terms of environmental risk or those related to social or political upheaval. So even having that ESG-based lens, you might call it something else, but that perspective does enable risk-adjusted returns in a way that's more prudent, as opposed to just disregarding things like climate risk, which we talked about already so far today, and it's something that train has otherwise left that station.
Great. Well, we're wrapping up here. So our parting thoughts, are there any key messages you would like to leave us with on the topic of how to advance infrastructure, sustainable infrastructure in emerging markets? Any last parting thoughts?
Maybe one thought. I mean, we always say that there's no one size fits all approach when it comes to investing in emerging markets. Every project is different, and it requires thoughts and considerations on the structuring, and also an in-depth due diligence to get comfortable with the risks and make sure they're properly addressed in any project.
Yeah, fully agree. I think it's nicely put.
Great. Okay, so thank you very much, Barry, Naomi, and Sharina. We very much appreciate your contributions to this webinar today. Thank you.
Thanks, everyone.
Thanks for